Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. We have resurgent risk appetite lifting stocks, bonds and the dollar as President Trump says he has no plans to fire Fed Chair Jerome Powell. Optimism about US trade negotiations also boosting market sentiment. Trump signaling he's willing to strike a deal with China that tariffs will come down substantially. And coming up, we ask Zuma Wealth why they remain bullish on US assets and where else they're putting their money amid the trade uncertainty. And Elon Musk eases Tesla investors' concerns as he vows to devote more time to the EV company, pulling back from his government work. Well, our top story today, President Trump pulling a major about-face when it comes to his stance on China's tariffs and the Fed. Trump's now saying he's not getting rid of Jerome Powell, despite criticizing the Fed chair in a series of social media posts and public comments.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
All right, well, Trump is also now saying that the final US tariff on China will not be anywhere near the 145% level that he set, even as those trade negotiations remain to a standstill, as we just heard. Well, let's get more on this. Bring in our senior Bloomberg editor, Derek Wallbank, also China correspondent Min Lo. So, Derek, we're going to start with you. We heard there from President Trump saying, well, Jay Powell's safe in his job for now. But is this really enough for markets? Because he did follow up by saying he'd like to see an interest rate cut. So can we really put to bed all these questions about Fed independence?
Well, Paul, I think for now, this is a clarity point from Donald Trump, who has long said that he reserves the right to jawbone the Fed and say what he thinks that the Federal Reserve needs to do at any given point. There had been a lot of speculation, as you quite rightly noted, that Trump was going further here and saying that indeed what he wanted to do was explore options to get rid of Powell, or maybe he wanted to get rid of Powell entirely, right? A sort of, will someone rid me of this meddlesome priest kind of moment. Trump here, recognizing, I think, that markets had been a bit rattled by that sentiment, did say very clearly that he does not have plans to get rid of the Fed chair, but again mentioning that he thinks that it's time for the Fed to lower rates. Now, look, let's be really clear. In Trump's first term, the Fed was a lot more accommodating in trying to manage the short-term risk of the trade war. So far, in his second term, the Fed has not acted in similar ways. And so this is something where the president has been frustrated that he has not gotten accommodation from the central bank. He would like to get more, and he's trying to use some influence there. But markets should certainly read this as a softening off of some of the positions that some people had been taking.
Yeah, perhaps a softening as well, with President Trump's latest remarks on China. Does that affect prospects for a trade deal?
Yeah, it does seem to be quite a shift in his tone now, because he was asked by reporters whether he will play hardball with China, and his answer was a clear no. And he said the final tariffs are going to be not anywhere near the 145%. He said it's not going to be zero, but China is going to be very happy with the deal. But again, it's been a lot of sound bites, but not a lot of action. Nothing has really changed so far, although we did have the Treasury Secretary Scott Bessent also reassuring markets in a closed door event, an investors summit hosted by JP Morgan Chase, where he said this standoff with China is no longer sustainable for both sides. He said both US and China will have to find a way to de-escalate tensions, quote, in the very near future. Although he did caution that any sort of big comprehensive deal is going to take 2 to 3 years to iron out, but it does seem like maybe the pain in US markets and economy is perhaps giving the administration a little bit more urgency to tout some of these progress in these potential talks here. But again, with President Trump really eating some of his words when it comes to Jay Powell, it's hard to discern whether this is just a comment to shore up market confidence or if it's really a meaningful shift in his stance on China.
Yeah, and how is China likely to respond to this? Have they even picked up the phone yet?
Well, we haven't seen any new reaction from China officially since Trump's latest comments. And there are a few ways this could go, right? It is potentially an opening for China to reach out to Trump without losing face, given the softening of the stance from the U.S. But on the flip side, it also could be read as, another hit to Trump's credibility. And China is a country that really pays attention to sincerity and whether the U.S. is really keen for meaningful negotiations. So maybe, who knows whether President Xi will be open to be the one to reach out to the U.S. first. Who's going to start the ball rolling? That's still an open question. But we did have an early signal today with the fix. The PBOC still weakening the fix slightly when they could have strengthened it. And this shows that the central bank still sees that it's too early for now to strengthen the yuan, despite some of the soothing comments from Besant and Trump so far.
Derek, we also heard, of course, the Trump advisor Elon Musk says he's going to be refocusing his attention now to Tesla. Let's take a quick listen.
Starting probably in next month, May, my time allocation to Doge will drop significantly. I'll have to continue doing it for, I think, the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Derek, what else did Elon Musk have to say?
Well, those were the comments that I think markets were watching for. He later followed up on X saying that he wasn't going away from the project entirely, but he would be focusing a lot more time on his primary companies. This is something that we had seen a lot of watch from Tesla investors on, as that stock has been hammered since since before Inauguration Day. It's down quite a lot. And realistically, though, I should point out that Musk, in his role as a special government employee, was never going to be around forever. That's a designation that kind of, if you read the processes, literally expires sometime in May. And so they were going to have to figure out an exit plan for Musk. But let's be really, really clear. Elon Musk is the richest man in the world, and he is the top billionaire backer of Donald Trump. He spent millions of his own money to get Trump elected as president, and he has spent millions more trying to elect allies as recently as trying to weigh in on the Wisconsin Supreme Court race. So this is not a guy whose attentions are going to fall away from the U.S. federal government entirely. And he's also not a guy for whom the impact of what he has done for good and not so good, depending on your political preferences, that's going to be felt at Tesla for a long time to go. The reputation, as I say, either direction is going to be felt for a long time. And so I think that even if Musk changes his stance in terms of where he's spending the predominant amount of his time, the effects of what has happened over the last couple of months and his actions sort of in all sectors, government and on the companies he controls, is going to be felt for a long time to come.
All right, Bloomberg senior editor Derek Wallbank there, and our China correspondent Min Lo. And we're going to have some more on Tesla's earnings later on this hour. We're going to be joined by China Great Wall Securities EV and lithium-ion battery analyst Yun Mei. Let's take a look at our markets behaving in the wake of today's impressive news flow. Very much risk on across the Asia Pacific. All of the major indexes in positive territory. CSI 300 in China better by about 1/5%. The Hang Seng Index leading the way, though. Stocks in Hong Kong better by 2.3%. But really, we do see most assets pushing higher, including oil and even Bitcoin back above $90,000. Let's take a look at traditional gold prices prices as well. We've seen some dramatic movements there. Gold initially punching through $3,500 per ounce after pulling back on those announcements out of the Trump White House earlier today. Spot gold right now, $3,345. Perhaps a story of dollar strength as well, because those remarks really did put a floor under the greenback. The dollar spot index recovering some of the ground that it's lost. And S&P futures, after a positive day, looks like we're setting up for another positive open when the US begins trading again. Well, our next guest also remains bullish on US stocks, believes the S&P 500 is going to be higher 6 months from now. Let's bring in Terri Spath, founder and CIO of Zuma Wealth. So, Terri, is the gameplay fairly simple here? Just buy the dip, get long?
No, yeah, I wouldn't say, I wouldn't suggest that. I do think it's a mistake to be completely out of U.S. equities at this stage of the game, especially with the drawdowns that we've seen. But, you know, the risks are still there. You know, all the news that you just covered highlights how headline risk is especially acute during these periods of extreme uncertainty. We're certainly seeing that now. And so while we do think that between now and year end, we'll probably be higher in the U.S. markets than we are right now. We also recognize that the risks are much higher than they were at the start of this year. And we also want to make sure that we've got a well-rounded portfolio that includes a lot of the asset classes that are showing a lot of strength outside of the U.S. And so that's something that we think is really important for investors and for our clients as well right now. Not just U.S., but there's a lot of other assets out there that we think have less risk and better, or at least as good upside return.
Yeah, absolutely. The environment does remain complex and uncertain as well. And if we take a look at some of the U-turns that we've seen just a few hours ago, President Trump now saying he'll be very nice to China. Those 145% tariffs won't be there forever. But as Min was explaining earlier, we've not really heard anything from China at the moment. Seem to be operating out of the Sun Tzu playbook, never interrupt your opponent when they're making a mistake. How optimistic are you that we're going to see some movement on the trade front?
Right. I mean, that was interesting. And as you highlighted, you know, it's not exactly like China's picking up the phone and calling the Oval Office right now to make some negotiations. And I think that's a telling statement that was made. I think, you know, what we're really learning with this administration is the use of tools, for lack of a better word, that weren't used that way in the past. And tariffs are a huge example of that. They're not usually used as a negotiating tactic. And it's hard to tell when they're being used that way and when they're actually going to be policy that investors can count on. And that's what's creating so much confusion. So we're spending less time trying to figure out the exact numbers in the exact countries and really recognizing the fact that international equities struggled to capture investor enthusiasm in recent years. But in that first quarter and continuing to today, we're really seeing signs that that tide might be turning in China, in Germany, in Japan. That outperformance that we're seeing, we think that the factors are still in place, and the two main ones are valuation discrepancy, and these countries are reacting. We're seeing that they're really leaning into fiscal stimulus. China, as you're highlighting, they plan on widening their budget deficit. And while we think it's a little early to get too excited about China, we are paying attention to that. Germany is a place where we're feeling a lot more comfortable. They've unveiled a huge infrastructure fund, planning on easing restrictions on government borrowing. And on top of that, cheap valuations relative to the U.S. So we're not sure what the exact numbers on tariffs will be for China, or how it's going to play out with Canada, for example, or Germany. But we are seeing these low valuations and increased growth outside of the U.S. And we think it makes sense to make sure that you've got a lot of allocation outside of just the U.S. At this stage of the game.
Let's talk a little about the impact of tariffs within the US, because we had President Trump again today calling on the Fed to cut rates. I mean, the Fed is in no hurry to do so until it sees price stability, and there's some concern there about the tariff impact. Let's take a listen to Fed member Adriana Kugler, what she had to say about this.
The economy is facing heightened uncertainty with upside risk to inflation and downside risk to employment. This month, we learned that the tariff increases are significantly larger than previously expected. As a result, the economic effects of tariffs and the associated uncertainty are also likely to be larger than we anticipated.
Well, Terri, what impact do you anticipate the tariffs are going to have on inflation in the US?
Well, I mean, it's a little bit confusing, I guess, at this point, and I'm not the only one that's confused by it. But what we want is tariff policy. I don't like seeing this used as so much negotiation. And I think once there's policy set in place, not something that's changing year to year or month to month or even week to week, because that's not allowing businesses to adjust. So, that's the problem that we're seeing, and that we're seeing businesses potentially not spending as a result. Consumers rushing to buy things they think might be more expensive in a couple months, and then not necessarily having funds to spend in the future. And that's going to wreak havoc on the U.S. economy. We're not necessarily concerned that tariffs per se will lead to inflation. What we are concerned about is that they could, maybe potentially temporarily depress economic growth because of the lack of clarity that American consumers and American businesses have at this stage of the game. And so again, we want a tariff system that's sustainable, not one that's changing every single week or even from day to day and just sloshing around expectations for what a company is supposed to do. And that's we're looking for that to settle down and hope to see that to get the risk out of the U.S. Right now.
Well, if you're proven correct, if the growth question turns out to be a more pressing one than the inflation question, what's your time frame for potential easing from the Fed in 2025?
Well, it's interesting now that we're not as worried about Powell potentially losing his job. I think maybe he'll be able to focus a little bit more, and the rest of the market will be able to focus a little bit more on what the Fed is actually going to do. I think that there's room right now for the Fed to reduce interest rates. The era of easy everything is gone. It was easy everything for a while. We had expanding and easy money. We had a lot of fiscal stimulus, but now these tariff negotiations have created so much confusion and added all up. And what we have is, what looks like sluggish GDP growth here in the first quarter, and that could very likely continue into the second quarter, if not worse. We don't think it'll be worse. We're not expecting a recession, but it's sluggish. And on balance, we think that that outlook is fair. It does suggest some modest room for the Fed to cut short-term rates when it meets in May, but given their history, given their language, we think they'll probably kick that can down the road and wait to make a decision in June, and at which point we think that there's going to be good evidence to cut rates, but we wouldn't be surprised if that doesn't happen as well. But we're hoping that it does.
Well, we're also heading into earnings season. We heard from Tesla earlier today, and the market liking the news that Elon Musk is going to be stepping back from his role in the government. We're going to be hearing from Alphabet tomorrow. What are your expectations around earnings, particularly for the rest of the Magnificent Seven? And do you think this good news on the trade front might have come just soon enough to reduce the impact on the outlook for some of these big companies?
Well, we'll see. Yeah, it was interesting to hear Musk say that he was going to be spending more time on Tesla. Not entirely surprised given the stock price and the massive wealth that he has seen evaporate in very short order. He's still a very wealthy man, but it's still got to hurt to lose that much money that quickly. Tariffs will loom large over this round of corporate earnings. I don't think that's going to surprise anyone with that statement. We are in the early stages of earnings season, and companies, the few that we've heard from so far, are actually beating expectations, lower than what we've seen in the past, but still pretty good beats. We have about a fifth, I think, of the S&P 500 reporting in the week ahead. It's a lot of the Mag 7, but other big names like Pepsi, like Intel, like American Airlines. My personal favorite, Chipotle, is reporting soon. And so when we hear from on those earnings call, we'll get a really good sense, I think, about how trends are potentially deteriorating or perhaps improving. And this importance of this Q1 reporting period is going to be the information that's provided on the macro backdrop and how much haze that they're expecting in the second quarter. I wouldn't be surprised if we see a lot fewer companies even issuing guidance, earnings guidance, because of the uncertainty that's been going on. So I think, we're not fully expecting the earnings seasons to save the day in terms of stock prices here in the US, but we are looking for the information that's the C-suite can provide us in terms of any changes they're making to their own plans, and if they're even going to give us earnings guidance going forward or not.
Yeah. Terri, very quickly before we let you go, just want to get your view on the one asset that's absolutely been crushing it in 2025, and that's gold, which briefly cracked 3,500 an ounce today. It's still got strong momentum, but is it looking overbought now, especially as some of the White House rhetoric cools?
Gold has been like it is a pun I didn't mean to make, but the shiniest part of our client portfolios recently. It's really been saving the day with its low correlation, negative correlation related to a lot of the other asset classes that we have. It's that safe haven trade, that dollar weakness trade. It bodes well, for an inflationary part of your, protection part of your portfolio. So we like it right now. This is the first time we've put it in portfolios in a long time. We've had it in there for several months, but this is a trade. This is not a long-term allocation that we have to gold, and we'll be watching some technical indicators to see when we might want to exit that, what has been a thankfully productive trade in 2025.
All right, Terri Spath, we'll have to leave it there. Thanks for joining us. Terri is founder and CIO of Zuma Wealth. Now, for a look at what's ahead this hour, let's get over to the Shanghai Auto Show. Our Chief North Asia correspondent, Stephen Engels, right there. Steve.
All right, thanks, Paul. Well, President Trump's tariffs are obviously on the minds of many of the participants here at the Shanghai Auto Show. Our interview with Pony.ai founder and CEO James Peng here at the Pony.ai booth at the Shanghai Auto Show. He talks about the trade war and how it's impacting his company's prospects. That's coming up here on Insights. This is Bloomberg.
Well, it's been an interesting day for foreign exchange markets as well. We saw the dollar strengthen after we heard from President Trump earlier this morning, saying not only is he not going to fire Jay Powell, he's going to be very nice to China as well, and those 145% tariffs are not going to be in place forever. We did see the dollar strengthening against most of its peers. The yen 142 now against the greenback. It was touching 140 yesterday. One exception to that, the Aussie dollar, pretty strong at the moment, perhaps related to a bit more optimism around the currency space. The yuan, though, still pretty weak, so China showing that it's not quite willing to let its currency strengthen yet. Let's take a look at Bitcoin as well. We saw some pretty impressive moves there. Bitcoin back above $92,000, rising also after we heard those remarks from the president. So optimism there over easing trade tensions. Also the report of a potential $3 billion special purpose acquisition vehicle for cryptocurrency as well. So that rally taking Bitcoin back above 90,000. Still to come, Tesla shares also jumping after hours as Elon Musk signals he'll pull back from Doge to refocus on the EV maker. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at how China assets are tracking as mainland markets head to the lunch break. It's mostly risk on day. We've got the CSI 300 now better by about 0.25%. Shanghai Composites flat, but we're seeing some big moves on the Hang Seng. Stocks in Hong Kong are the best performing major market in the region, better by about 2.25%. The yuan is interesting, continues to remain fairly weak despite some rather conciliatory remarks from President Trump this morning on the trade relationship with China. We did get a weaker fix than usual, so policymakers not quite ready to let the yuan appreciate just yet. We've also got Japan returning from its lunch break. It's been a pretty good day for Japanese stocks so far. The Nikkei better by 1.7%, a little bit more than that, perhaps helped along by a slightly weaker yen. 142.10 right now. The yen started off the day with a 140 handle, so those remarks from President Trump helping to strengthen the dollar and bring it off some of those months-long lows that we have seen. Well, Tesla's suppliers are in the spotlight here in Asia as well after the EV giant stock rallied and extended trading in New York, and that's despite reporting a first quarter profit miss and backing off its earlier prediction that sales would return to growth this year. Investors, though, welcomed the news that CEO Elon Musk is promising to pull back significantly from his work with the US government to concentrate on Tesla. Musk also downplayed the possible impact of Trump's tariffs on the business.
We are, I think, the least affected car company with respect to tariffs. We do have localized supply chains in North America, Europe, and China. So that puts us in a stronger position than any of our competitors.
Joining us now is Yun Mei, EV and lithium-ion battery analyst at China Great Wall Securities. Mei, thank you so much for joining us today. I'm just wondering how challenging you're finding it at the moment to gauge the outlook for Tesla in this environment of trade and tariff uncertainty.
And I think today is a lucky day for Tesla and Tesla's Chinese suppliers. As the Mr. President said, they will help to release the tariffs to make the economy more predictable, especially for the tariffs, because on average, the gross margin for automotive part manufacturers is around 20 to 30%. Few of them can reach beyond 40%. So if the tariffs goes too much, there is no room for Tesla or its suppliers to survive during the tariffs war. So today is a very lucky day. We will see what happens.
Yeah, apparently so. Are you seeing any evidence of Chinese suppliers willing to absorb the cost of those increased tariffs or by lowering prices, or are those costs just being passed on?
They can't do that because it's very, very competitive at the moment. The price war for the EV has lasted for decades, for like 3 years. There's no room for any cost, for any price cut at the moment. It's only like, as far as I know, I did some field trip already. They all told me that they will pass the tariffs to the American factories or the American car automakers. They have to do that. No other options.
How difficult is this going to be to make it for Tesla to provide more affordable models, perhaps a low-cost model as well? What's the impact of this going to be on the bottom line?
I think at this moment it will be not a good timing for Tesla to stick to the affordable cars because the macro environment is changing. The affordable car goes with the high interest rate, and I think we will see the turning point very soon. And plus that, when Musk said they will produce the affordable cars, they are the only one who said that. But nowadays in China, we can see many, many affordable car models, and many of them will be sold in Europe. So why Tesla fighting a right say?
Yes, Tesla does face a lot of competition in terms of affordability from Chinese competitors, and if it's having to absorb some of these more expensive input costs, what's your outlook for sales growth recovery from Tesla? Did you believe what you heard today?
I have a strong faith for what I heard today because actually Musk is still very important for the American people, or he plays a crucial role in the American government until now. So I think he must have tried his best to influence the government to give him some room to continue his business. So he has to do that. We can see the figures that the gross revenue from the company falls under the expectations of the Wall Street already. And it's already on the edge of that. If the trend continues, plus the tariffs, the gross margin for this company will be very ugly.
We also heard earlier this week from another analyst, Dan Ives of Wedbush. He saw 15 to 20% permanent demand destruction for Tesla because of Elon Musk's work within the government. Do you think that that is reasonable, and how much damage do you think has been done to the brand over the past few months?
Huge damage, I have to admit, because the people who are the most willing to buy the EV are the people who most anti-globalization. So how can the leader of a EV company do that to his customers? That's a branding disaster, I guess.
Well, Tesla's also said that the tariffs have more impact on its energy business rather than its autos business because a lot of the lithium cells that it uses comes from China as well. So how important is it that the US and China reach a deal for the sake of Tesla's energy business?
I totally agree with what Musk have said, because lithium business is much different from the EV business. It involves the critical minerals, which can be only found in China. And if without the suppliers, the suppliers from China, they can't make a lithium battery. Not to mention, it's one thing to invent a lithium battery, and the other thing to keep a reasonable yield rate. That's what had happened to Tesla before. When they are trying to make the new battery for the Cybertruck, they face a very difficult situation that they just could not ramp up the production volume. And that's the strength from the Chinese suppliers, because we have the top lithium battery companies in the world, and we have so many engineers who know how to make a lithium battery, and that's the key part. It's one thing to invent one, and totally another thing to make profitable for the volume, massive production.
Just finally, we also heard Elon Musk again emphasizing that he sees robotics, artificial intelligence, autonomous taxis as being the future for Tesla. But of course, the timelines for these ideas have always been quite uncertain. When do you see this bearing fruit?
I think maybe I would like to be more conservative for that part. Maybe in 3 years, I guess. But still, I have strong faith in that part, because Tesla and Musk relevant companies like XAI and X, they have a very, very first mover advantages in that industry. Just like back in the days that the Tesla was the pioneer in the EV industry. And we can see that there are many data from the thousands of the Tesla cars running around the world. So the company could collect and record the data from all over the world and in different situations which could help them to build an artificial physical world. And then again, the X platform, the social media, they gave a very good feedback for how real people emotionally react under certain environment. So then the two comes together, they will be a human robot.
All right, Yun Mei, EV and lithium-ion battery analyst at China Great Wall Securities. Thank you so much for joining us. Let's stay with autos and EVs. The 21st Shanghai Auto Show is getting underway with the Trump tariff war hanging over industry conversations. Chief North Asia correspondent Stephen Engel is at the venue and joins us now. So, Steve, how is the mood there at the 21st Auto Show in Shanghai?
Well, you know, it's pretty upbeat, and it's absolutely packed and noisy as it usually is. You know, you would think that the tariff situation is front and center of everyone's mind. Well, it is when I raise it in interviews, obviously, but I think a lot of people here are focusing on their advancements in technology, in self-driving, but they're not really allowed to call it self-driving anymore. It's more advanced driver assistance. And those kind of cockpit enhancements are on display everywhere in this massive complex here on the outskirts of the city of Shanghai. You know, of course, the Trump trade war is on the minds of companies like Pony.ai. We're at their booth right now. They do robo-taxis. They've just announced today their 7th generation of their robo-taxis with partners including Volkswagen, but also Beijing Auto and Guangzhou Auto. And that's rolling out soon. I had a conversation with the co-founder and CEO, James Peng. This is what he had to say about why they're focusing more on China right now because of the external situation.
Yeah, I think from the launch markets, we're a bit affected. As of now, I think China has the strong demand from the users, has strong support from the regulatory front. That's why we're focusing in China market for now. Although we definitely have some international markets expansion as well in South Korea, in Luxembourg, in the Middle East, Singapore, and whatnot. I think the trade war, in terms of the components and the computer chips, we're actually not really that much affected because we have different sourcing across the globe.
How is it different, though?
Because most of the components are not really manufactured in the U.S. per se. They're actually also the global, and we're trying to have different suppliers and partners on different markets so that we can have insured supply chain.
How has the overall trade friction, though, impacted your ability to sign new partners and new customers, new automobiles that want to use your technology?
I think the effect is rather limited. I mean, the effect is not really that big for us because we are focusing on the non-US market for now. That means we're currently not working with the US car manufacturers. And we're expanding into other markets. As Steve, you mentioned, I think the trade war will affect us maybe in the long run, but at present, I think our business, our R&D, our development are really not affected.
What's your next priority market to go into?
I think it's Southeast Asia, East Asia probably more, Japan, South Korea, and Europe, and the Middle East. Those are the three main regions.
The Ministry of Industry and Information Technology out with new guidelines and regulations to kind of increase scrutiny on autonomy and self-driving. They don't want car makers to call it self-driving. They want driver assistance because, again, there was the Xiaomi fatal crash, which kind of raised the safety issue. How is that going to impact you with your robo-taxi services and fleets?
I think in a way it's make the distinction between driver assistance system and fully driverless more clearer because we are really developing fully driverless. And the fully driverless means the car's safety is responsible by the vehicle itself, whereas driver assistance system is still the driver's responsibility. I think because of the current regulation or the current requirements, it's actually make us easier to stipulate the distinctions.
Steve, we're also following a Bloomberg scoop that Xiaomi is delaying its first SUV after a fatal accident involving its top electric car. What more do we know about this?
Yeah, that's right. I think Xiaomi is trying to be a little bit low profile right now because we do have the Ministry of Industry and Information Technology coming out with new guidelines and trying to raise the prospects of safety being built into these self-driving programs, because that accident on March 29th killed 3 women who were on an expressway at about 25 minutes or thereabouts before the accident happened, when the SU7, Xiaomi's only EV right now, crashed at high speed into a concrete wall, killing them, and then also burst into fire. So they're trying to do a significant investigation. The regulators are. There's new guidelines as well on the development of self-driving. They don't really want car makers to be calling it self-driving, maybe assisted driving. They don't want to encourage people to take their hands off the wheel. Now, that new SUV, the only SUV that Xiaomi was expected to unveil here at the Shanghai Auto Show, that's the YU7 or the U7. That was going to be the new flagship SUV from Xiaomi, and really a cornerstone for that car maker, that mobile phone maker turned car maker. We were expecting it to be rolled out in June or July. It is now, we're hearing from sources, been delayed because of that accident and because of the added scrutiny that is coming from the regulators.
All right, Bloomberg's chief North Asia correspondent Stephen Engel there at the Shanghai Auto Show. Still to come, the IMF's outlook for the global economy growing darker. We'll hear more from IMF Managing Director Kristalina Georgieva next. This is Bloomberg. The International Monetary Fund has slashed its world growth forecast for this year and next, citing risks from a global trade war. Managing Director Kristalina Georgieva also told Bloomberg that the chances of global recession will rise if uncertainty over tariff policies drags on. She spoke to us on the sidelines of the IMF's annual spring meetings in Washington.
Trade is an engine for growth. And what we see these days is that when trade goes backwards or slows down, that has implications for global growth. As you know, we just projected the growth expectations for 2025. We are downgrading by 0.5 percentage point from 3.3 to 2.8%. Our forecast for the world, we are downgrading our forecast for almost all countries, including the United States, as a result of trade tensions.
Yeah, one thing that in that world economic outlook, you put the chance of recession in the United States up to about 40% from 27% back in January when you first published it. If the tariffs stay as they have been proposed from the United States, do you expect that chance to go up materially?
This is based on the announcements of tariffs that have been then suspended, but not for China. So it's a complicated story. The short answer is that we are operating at a time of very high uncertainty. If we see faster resolution of trade tensions, that would possibly lift up projections for global growth, great for investors, great for families. If, however, we do not succeed and uncertainty remains very high, tariff problems hang on our head for much longer, then we actually can see even further reduction in global growth, and then the danger of recession looms bigger. What is our advice? Please talk with each other, find a way to resolve differences, and above all, reduce uncertainty. Uncertainty is bad for business.
And I think a lot of people have raised that issue. There has been speculation, including by this administration, that the United States could potentially even withdraw from the IMF. Do you see that as likely or possible? Do you have contingency plans for that?
We have very good relations with the United States. We have traditionally worked very closely with each and every U.S. administration. We have now established relations with this administration. The United States is carrying out reviews of its participation in international organizations. This is very fair. They have the right as a member to look into the mirror and say, do we have value from participation at the IMF? And I can tell you, I'm convinced that they look at this and they say, yes. Why? First, we are the only institution that can rescue countries in trouble. There are many countries that the U.S. cares about, that the fund is there to help them in a moment of high trouble. Two, we are the only financial institution, Lisa, that is like a savings bank. The U.S. puts money, we lend, then we give it back to the U.S. with interest. The last 2 years, we have paid $3.1 billion in interest to the United States. So, you know, the concern is, are taxpayers of the United States paying? In the case of the fund, no. And three, we are promoting things that the U.S. cares deeply about. Private sector-led growth, discipline, transparency, accountability. And I think for all these reasons, and also let me not forget, where are we? We are sitting with you 2 blocks from the White House. I think that the outcome of this review for the IMF would be, yes, great institution, we stay.
That's IMF Managing Director Kristalina Georgieva speaking with Bloomberg's Lisa Abramowitz in Washington. Well, here are some more top geopolitical stories we're tracking. Indian Prime Minister Narendra Modi has cut short his trip to Saudi Arabia after gunmen killed as many as 26 people in India's northern Jammu and Kashmir region. The Press Trust of India says the attackers opened fire on tourists and 2 foreigners were among those killed. US Vice President J.D. Vance is currently visiting India and described the attack as horrific, while President Trump offered full support. Officials say trade talks between the US and Thailand, due to start Wednesday, have been postponed. The delay comes after Washington asked Thailand to address certificate of origin misuse and currency manipulation. No date has been set for a resumption of negotiations. Let's take a look at how Asia FX is tracking at the moment. We're seeing a little bit of weakness for the yen, or is that a dollar strength story? The offshore yuan is holding a little bit weaker than expected, despite some of the trade rhetoric easing out of Washington today. Take a look at the Indonesian rupiah as well, as we await a rate decision from Bank of Indonesia. No change expected, an estimated hold at 5.75%. Before we go, here is a look at tomorrow's show. We're going to have market analysis with Mercer's Cameron Sisterman. That is, as investors keep an eye on trade talks in Washington. That's it for Insight. Horizons Middle East and Africa next. This is Bloomberg.